On September 15, 2008, a single court filing triggered a global financial heart attack. $639 billion in assets vanished overnight as Lehman Brothers filed the largest bankruptcy in American history. Lehman Brothers had survived the Civil War, 2 World Wars, and the Great Depression. It did not survive 2008. The firm's stock had traded above $60 a share the year before. On the day of the bankruptcy filing, it closed at pennies. Roughly 25,000 employees lost their jobs in a single week, and thousands of them watched a large share of their retirement savings, held in company stock through Lehman's own employee retirement plan, disappear along with it. Lehman Brothers began in 1850 when 3 brothers, Henry Emanuel and Mayer Lehman, German-Jewish immigrants, opened a dry goods store in Montgomery, Alabama, and began trading cotton. Over the following century and a half, the firm grew into one of the largest investment banks on Wall Street, surviving the panic of 1907, the 1929 crash, and its own near collapse and sale in 1994. When it was spun off from American Express as an independent company again. By 2007, Lehman was the 4th largest investment bank in the United States, with more than 25,000 employees across the world. Richard Fuld had run Lehman since 1994. Inside the firm, people called him the gorilla for a management style built on aggression and control. While rival banks began pulling back from the mortgage market as early as 2006, sensing trouble, Fuld pushed Lehman further in. The firm expanded its holdings of mortgage-backed securities and bought 2 subprime lenders outright, betting that the housing market's slowdown was temporary. It wasn't. By 2007, the securities Lehman had bet on were losing value fast, and the firm had financed most of its balance sheet with borrowed money, at a leverage ratio later estimated near 30-to-1. A small drop in asset values was enough to wipe out the firm's actual capital many times over. As losses mounted through early 2008, Lehman had a problem. Its own balance sheet, if reported honestly, would have alarmed investors, rating agencies, and regulators all at once. So at the end of each quarter, Lehman used an internal accounting maneuver its own employees nicknamed Repo 105. The firm temporarily sold up to $50 billion of troubled assets to other banks, just long enough to make its books look healthier at reporting time, then quietly bought the same assets back days later. A bankruptcy examiner's report published in 2010 would later call the maneuver a material misrepresentation of Lehman's financial condition, used specifically to hide how over-leveraged the firm actually was. In March 2008, with Bear Stearns already collapsing around them, Lehman's chief financial officer Aaron Callan told analysts on a public call that the firm's liquidity position was strong and that it had no need to raise more capital. 3 months later, she was gone, replaced as the firm's actual condition became harder to hide behind reassurances. No American law firm would put its name on a legal opinion certifying that the Repo 105 transactions were legitimate sales under U.S. accounting rules. So Lehman routed the deals through a subsidiary in London and obtained the opinion it needed from the British firm Linklaters instead, under English law, which took a more permissive view. The workaround itself was evidence that Lehman's own lawyers understood exactly how the maneuver would look if it were ever examined closely. Through the summer of 2008, Lehman searched for a capital lifeline. In August, talks with South Korea's state-run Korea Development Bank appeared close to a deal that could have injected billions of dollars and calmed the market. When word leaked that KDB had walked away without a deal, Lehman stock collapsed nearly 50% in a single week, and other banks began treating Lehman as a firm that might not survive the month. JPMorgan Chase, which processed Lehman's daily trades, was one of them. In its final days, JPMorgan's CEO Jamie Dimon demanded billions of dollars in additional collateral from Lehman to keep clearing its transactions, a move that protected JPMorgan but drained the cash Lehman needed to stay alive. Treasury Secretary Henry Paulson and New York Fed President Timothy Geithner spent a frantic weekend trying to broker a private rescue, the same way the government had arranged Bear Stearns' sale to JP Morgan 6 months earlier. Bank of America looked at Lehman's books and walked away, choosing instead to buy Merrill Lynch, a healthier firm, in the same 48 hours. Barclays wanted to buy Lehman too, but British regulators refused to approve the deal without a US government guarantee behind it. And this time, unlike with Bear Stearns, Washington refused to provide one. By Sunday night, there was no buyer left and no bailout. Lehman Brothers filed for Chapter 11 bankruptcy protection at 1:45 in the morning on September 15, 2008. By mid-morning, photographers had gathered outside Lehman's headquarters on 7th Avenue to capture employees walking out carrying their belongings in cardboard boxes, an image that ran on front pages around the world and became one of the defining pictures of the crisis. Global markets opened in panic. The Dow Jones fell 500 points that day, its worst single-day drop in 7 years at the time. Credit markets, already fragile, froze almost completely as banks stopped trusting each other's balance sheets. A major money market fund, the Reserve Primary Fund, which held Lehman debt, saw its value fall below $1 a share, an event so rare regulators had a name for it, breaking the buck. It set off a run on money market funds across the country. The panic did not stop at Lehman's door. Lehman held enormous positions in credit default swaps with the insurance giant AIG. And as Lehman's collapse rattled the market, AIG's own obligations on those same kinds of contracts came due at once, pushing it to the edge of failure within days. The two firms didn't fail separately that September. They failed together, each collapse accelerating the other. Within a week, the government had to step in with a $182 billion rescue of AIG, followed weeks later by a $700 billion bank bailout program, TARP, to keep the rest of the financial system standing. Untangling Lehman's own bankruptcy, its assets scattered across dozens of countries, took years and cost more than $2 billion in legal and advisory fees alone. In the years that followed, Congress held hearings, and Richard Fuld testified publicly, defending his decisions and blaming the crisis on forces beyond his control. Despite the size of the collapse and the bankruptcy examiner's own findings about Repo 105, no senior Lehman executive was ever criminally charged. Over his 14 years running the firm, Fuld had been paid an estimated $500 million in salary, bonuses, and stock. He kept nearly all of it and never faced prosecution, a fact that became one of the most cited grievances of the entire financial crisis. Lehman Brothers didn't fail because no one saw the risk building. Regulators, rating agencies, and Lehman's own employees had access to the numbers for years before the collapse. It failed because the people positioned to act on those numbers had no incentive to act until it was already too late. And by then, the firm was too large, too interconnected, and too indebted for anyone to contain the damage to Lehman alone. Wall Street had built a system where the biggest bets came with the least individual accountability. And in September 2008, that system finally sent the bill to everyone else.